Hello everyone, welcome back to Upside Down Data. Today I want to talk about the recent Bitcoin rally and some key data we can look at to try to understand what is going on. If you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter, where we put out regular updates about our risk indicators and more. So I actually had taken a bit of a mini vacation, and oh boy, what a weekend to have done that, because the markets have been going a bit wild over the last couple days. We can see from the chart that I'm showing you here on TradingView just how much Bitcoin has been rallying recently, really kind of starting at when the Fed had their FOMC meeting. We've really just had a pretty sustained move to the upside, from this kind of local low up to here. Bitcoin's up over 25%. And from the absolute lows back in January, we are currently up at around 45%, currently trading at around 43% above those levels. And if you've been watching the markets, there's some key moving averages that people often talk about as being kind of these dividing lines between bullishness and bearishness. And Bitcoin has actually cleared through a number of those. So I'll show you the 20-week moving average. That's one that a lot of people look at very closely as being kind of this key dividing line. Bitcoin has sliced right up through that level so far, trading nicely above this. It's currently, the 20-week is currently at around 44.5K, and Bitcoin has sliced right through that, being several K above there right now. When you look at the 50-week moving average, Bitcoin is also well above that. The 50-week is at about 45.7K. And we can also look at the 200-day moving average, which is actually the one that Bitcoin has not been able to break through yet. It's actually, as we can see here, been bouncing off of it the last couple of days. So we get up, put in a wick at there, then price is pulled back. So the 200-day moving average has seemed to be acting as resistance in the last couple of days. And this is an important level to be watching, because if we just look at kind of the volume profile, so how looking just across this whole range and this kind of up and down we've been in for over a year, and just looking at the profile of volume that's happened, whereas a lot of the transactions taken place, we can see that this range here at around 49 to 50K down to around 47K is a place where throughout history a ton of volume has transpired in this general range. It actually makes a lot of sense that Bitcoin is running into some resistance here, that after clearing off this resistance down here at around 45K, 46K, we're now hitting some resistance at around 48K. So this will be a key level to watch. But the good news is that if we can clear above this, you can see the amount of volume that transpired above it is quite a bit lower than any of these ranges down here. In fact, the next places we might expect some resistance is up closer to around 57K, so quite a bit of headroom should we break out to the upside. That's kind of just a description of where we are, right? Some kind of key levels we've reached, and then some understanding about maybe why it makes sense we've run into some resistance. What I want to do now is turn to some of our machine learning based models we have here at the channel to get a more, I think, nuanced understanding of what might be going on, or just a different perspective of what the market is telling us. So where I want to start is the trend confidence indicator, the TCI. This is an indicator that I've been talking a lot about recently on the channel, because I think it gives some interesting early warnings about trend reversals for Bitcoin, or when we might want to start paying attention for moves back to the upside or downside. So the way this model works is that you just look at the current trend, and if you're in, say, an uptrend, you want the TCI to be green, because and that's basically defined as being above zero. If you're in an uptrend and the TCI is green, that's good news. That suggests that the trend has legs, that it might be able to continue. If you're in an uptrend and the TCI is red, though, that's bad. That means that the trend might be petering out. So we saw in the spring of 21, we were in this uptrend, but the TCI flipped down into the red, was actually trending down. That was a very bearish signal that was very concerning, suggesting that this uptrend was unlikely to continue. And then conversely, in the summer of 21, you see the TCI break out into the green well before price even had its reversal, suggesting that that was a point to start paying attention, that this downtrend wasn't very convincing, that a move to upside was likely, and that's exactly what we ended up seeing. And then again, recently, at the beginning of February, the TCI flipped green and has remained green ever since, really giving us a warning that, hey, this, even though a lot of people were calling this a bearish flag, like a bear flag, suggesting that they thought a break to the downside is likely to happen. So far, the TCI has been vindicated in that we've now broken to the upside. Of course, anyone's guess if this move back to the upside can continue, but certainly riding this from all the way down here, which is at around 36K or something, up to current levels, 37 or 47, 48K, that's a good amount of upside that could have been captured just believing the TCI here. And so that's what I really like about this indicator is it's a canary in the coal mine. It's a leading indicator. It can tell you ahead of time, before the market even has its crash or before it even has its reversal, to start paying attention that a reversal could happen. It front runs trend reversals. And that, I think, is a very unique aspect of it because there are very few indicators you will see that are capable of doing this. Most trend reversal indicators are lagging indicators. They require price to, for example, in the summer, the lagging indicators oftentimes didn't flip green until we'd already gotten up to around 38K on this move up here. TCI was already bullish before we made this huge move to the upside here. And what you can see is that right now the TCI is moving up, right? We're actually hitting about the same level we've hit on some of these pumps that we put in earlier on. So it'll be interesting to see what happens if we continue moving up and the TCI moves even further up. That suggests even more confidence in this trend. So that's why it's called the trend confidence indicator. It's a continuum. The higher you get, the more confident you can be in the uptrend. Whereas if you start trending down, you have to be kind of less confident in that uptrend. So right now, we're kind of back up to these levels. It would be great to see this move back up even higher, suggesting even more confidence in this uptrend, suggesting that we might be able to clear through some of these resistance levels in the price and put in an even higher high before maybe having to pull back. Although certainly a pullback from these levels, maybe retest some of these earlier levels of support, would be totally plausible and would not be totally unexpected to see us bounce off of the same level again that we've been bouncing off in recent days. Now, one of the nice things about this model is we can actually probe it and ask what specific price level it is watching as the dividing line between bearishness and bullishness. And right now that's at around 39K, a little under 40K. So we have plenty of wiggle room up here, right? If price has to go back down to 45K to hold that as support, for example, maybe even a bit lower, TCI wouldn't see that as being all that concerning because really it's seeing this level as being that dividing line. So this is what I'm going to be watching closely. Can we stay above 40K more or less? Because as long as we can do that, we're still more bullish than bearish from the TCI's perspective. All right, let's flip to a different model that we have here on the channel, the upside downside potential indicator for Bitcoin. And specifically, I'm looking at the long-term version that cares about moves that play out over months to years, a more macro time preference. And so basically, if you're not familiar with this model, it basically tries to capture risk, or specifically downside risk. So when you're up in the high levels, that suggests that the upside potential is probably exhausted and there's a lot more downside potential that's realistic. Whereas if you're down in these low levels, that suggests that upside potential is quite a bit more realistic than downside potential. And what you can see is that the UDPI was identifying this zone going down here as being relatively low risk. We got down to below -3 on this move down, and I'll show you the raw values in a minute here. We got down below -3 at the absolute bottom there in January, and then we've been slowly trending back up into more of these levels up here. That's where we are right now as we've started to realize some of that upside potential. So if we look at just the raw output over time, this is what it looks like on the long-term UDPI. So UDPI on the y-axis and then just across time here. You can see that we put in this bottom right there in late January, and then we've been slowly trending up ever since. And this is the way that the UDPI often operates, is that we'll put in these lows at kind of the bottoms, these local bottoms, and then start moving back up to the upside. We did that in the summer, and we've done that again here as we've realized some of that upside potential, up almost 50% from these lows back here. Now, from the long-term perspective, it still thinks there is quite a bit more realistic upside potential that could be realized, but we have, realized some of the upside potential. And so that's one of the things that, obviously the best time to buy for this rally was back then, but of course that's when the market was most fearful. But one of the most useful things about this kind of indicator is it gives you a data-driven way of evaluating those points. And the UDPI was telling us this is a relatively low-risk time to be buying back here. More downside potential was possible, and certainly with a very bearish macro picture, a lot of people thought this was going to come into play. But it didn't happen. And so, if one was using a more kind of a weighted DCA strategy, kind of slowly buying in more and more heavily as risk gets lower, one would have been stacking quite a few sats, down here, and then be enjoying quite a bit of profit as we move back up here. Now, one of the things that's interesting with this indicator is also it can give us some idea about the more macro picture. And one of the things that I've noted before, or talked about a lot, is this fact that on the long-term UDPI, bull markets tend to be kind of captured by higher lows on the UDPI, or one of the traits that, or one of the behaviors of the long-term UDPI is that in bull markets, you'll set in higher lows throughout until you get to your ultimate top, in which case you then set in a lower high, and you might go down into this kind of bearish state down here. And then again here, setting in higher highs until we get to the market cycle top, in which case we then fall down to a bear market where we're putting in lower lows, going down through here. And what we can see is that on this most recent market cycle we've been in, starting, if you define it as the end of 2018, you can see we've been putting in higher lows throughout. You can kind of draw a trend line, and you can see we've been putting in pretty steady higher lows as we go through. Now, one thing you might say is, well, isn't it concerning we put in a lower high up here? Well, yeah, it's certainly possible, although that does happen in the middle of bull markets, right? You could say that here we put in a lower high, then we want to get to our ultimate market cycle peak up here. You could say the same thing here. This is a lower high than here, then we put in our peak. So really, the thing that might be more diagnostic is putting in a lower low than the previous one back here. And so far, we haven't really done that from these more macro kind of lows. As you can see, we've been building this kind of trend line, and we haven't really broken down below. Had we broken down below this level back here, that might have been more concerning, suggesting we're going into more of a bear market. That hasn't happened. So obviously, you can take this with a grain of salt, but certainly just if you compare previous market cycles to each other, this still looks more like a bull market than a bear market, suggesting that maybe the market cycle isn't over yet. Maybe we're waiting till we really break up into these high risk levels again, put in that ultimate top before going into the bear market. Now again, obviously with a really bearish macro picture, a lot could go wrong that could really kind of abort this from happening, right? I think that left to its own devices, crypto is in a bull market and very well could just go put in a new all-time high and then, put in that top or going into a bear market. But if really, if there's a recession across the economies of the global economies, if there's a stock market collapse as part of a recession, if there's a huge commodities crisis driven by the war in Ukraine, if there are extreme events that unfold from that war in Ukraine, or massive spillover events, anything like that could obviously derail any kind of crypto bull run that we're seeing right now. But assuming none of those events happen, then this is still setting the stage, I think, for a continuation of the bull market, potentially. So to show the UDPI levels across the different time frames we have, so I was just showing you the long-term UDPI, which is at negative 0.5, so nearing kind of more of a neutral stance between upside versus downside potential. The medium term and the short term, we're seeing, again, more neutral kind of leaning here. So the short term is starting to move towards the upside, but again, not extremely far, relatively neutral. And so really what this is telling me is that, upside potential is certainly very plausible. The model thinks that's the case. And, any of these times where we've seen these runs to the upside, you slice through these levels and then you can still realize a good amount of upside potential after crossing through these levels. So that's certainly happened. This would just be normal behavior in a bull trend. It's just really telling you that you're not at the bottom anymore, which we all know just looking at the price chart. Obviously telling us that, the time to really be buying heavily was back when it was at -3. Now we're kind of getting more to neutral. But it's not the point yet where I'm overly concerned. I think that if Bitcoin remains bullish, if the stock market remains bullish, if we have kind of a big relief rally, there's more room back to the upside that is possible. But if this is just kind of a fake out, if this isn't really a continuation of the bull run, then there's plenty of this downside potential that the UDPI has kind of factored in, that it thinks that it certainly is possible that this is a fake out, we can move back down. So really, we're going to have to wait and see, and that's where we're going to be watching things like the TCI to see if we can stay above around 40K, watch some of those volume profiles, things like that. So the last machine learning based model that I want to talk about here is the momentum bias indicator. And so this is an indicator that basically tries to capture how much momentum is in the market at a given point. Is the momentum overall in the positive direction, bullish momentum, which can pull price up with it? Or is it in the negatives? Is it red? Is it bearish momentum that will pull price down, excuse me, with it? So what you want to see with the momentum bias indicator is it to be hanging out more in the green than in the red. That tends to be bull market behavior. You can see that in the run up through 2017, we're spending a lot more time in the green than we were in the red. And then the same thing going up here into this bull run up here. More time in the green than in the red. Whereas then when we had this capitulation down in the red, and then we've been kind of oscillating, had been oscillating around zero before going down into more bearish territory. And one of the things that we have to watch out for is that if we want to see a continuation of the bull market, we'd like to see the MBI really kind of get back up into these green levels here and then start resuming this more kind of equal oscillation around zero. Because that tends to be the behavior it shows as it builds into parabolic moves to the upside. We've seen that here, and we've also seen that here. These equal moves around zero before going up and then putting in these massive rallies. And one of the things that we have to be careful about right now is that in bear markets, what you can see is these kind of false moves up, these kind of moves up that get rejected down to the reds or just getting rejected right at zero. We've seen a number of rejections right at around zero that have led into continuations of more bearish price action. And that's what we want to avoid right now. We've just closed in the green for a couple days. We'd like to see that continue. We'd like to see to really move back up and then come down and then not just kind of capitulate deeper down into the red. We can see any move back to the red, quickly reverse back to the upside, and then just a slow, steady kind of move into some parabolic move to the upside, if that's where we're heading. If we're really heading into kind of the final stages of this bull market that we've been in ever since kind of here. If you're talking about a macro uptrend ever since 2018, that's what we'd like to see. And we might be building into some of that. Something that might suggest that's happening is that kind of oscillation around zero building into this big crescendo that kind of leads us into the end. So anything that happened, we're going to have to wait and see. But that's something that I'm watching. And I think my overall read across these indicators, the TCI, UDPI, and MBI, is that we're not in a bad place, right? The TCI is bullish. That's good. The UDPI is not overextended yet. That's also good, suggesting a continuation could happen. And the MBI has flipped green for the first time in months, which is very nice to see. This is something that we haven't seen ever since November of last year. And so if we can continue this and really bring this back up, that will be quite bullish in my opinion. But again, it's a little bit too early to crack out the champagne and think that all-time highs are imminent. We're going to have to be watching these key resistance levels. It's totally plausible to me we get rejected off of the 48K range and have to go down a bit more. And who knows, it could be a just a relief rally that leads into a broader bear market. That is certainly plausible. We're going to have to wait and see. But so far, so good. All right, if you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter. And remember, with the TCI, the UDPI, and the MBI, we're all good.